Micron shares falling today after the company forecast failed to meet lofty expectations that investors had set for the AI space and for this company in particular. Now, this comes off the back of a wild ride for Nvidia this week after the company briefly topped Microsoft as the most valuable in the world. Now that stock is down almost 5% over the course of the last 5 days. So should investors be worried about a potential AI bubble to come? Joining us now is the founding partner of Lead Edge Capital, a venture firm focused on the tech and software sector, Mitchell Green, here with us in studio. Mitchell, thanks for being here.
Thanks so much for having me.
So talk to me about what you're seeing in terms of the concentration, right? Because obviously this is causing some concern for investors who love to say Nvidia is the new Cisco. Are you seeing this moment as a bubble?
Do the investors who say that, do they say it's overvalued, or do they say we're going to ride Cisco for a while still?
Oh, a little bit of both.
So Nvidia is a long, if you believe, so we think AI, stepping back, we think AI is very real. We have not made any AI investments ourselves. Happy to walk into why I think it's real. We think it takes a lot longer than it does. But specifically related to Nvidia, you own Nvidia today, it's like $120 stock or whatever roughly it is, probably do $4 to $5 of earnings next year. So it trades at 30 times. Given the growth rates, it's not crazy expensive. I think there's one fundamental thing. If you believe the hyperscale, and they're a long ways away from their competition like AMD and some of these all smaller companies that are attacking at the fringes, but these guys have built an incredible business and incredible chips. If you believe that the hyperscalers who are going to spend giants amount of money, I should say hyperscalers and the Singaporean government and the Middle Eastern governments are going to spend more money next year on this stuff, then it's probably a long. If you think that this CapEx could be some sort of slight bubble, it's probably a short. What we think is it's very real, but this stuff is going to take a lot longer to play out than people think. And it's our belief that it's like the telecom bust in the late 90s, early 2000s, where people massively overbuilt capacity. You're going to also, we believe here, see costs come dramatically down over time. If you wanted to build a website in 1997, you went to Sun Microsystems and spent $50 million to build your website. Today, you pull out your credit card, spend $25 and go to GoDaddy. Same thing's going to happen with AI.
So then what does that shakeout look like?
If you are a lot of the VCs plowing money into some of these companies, we think there's going to be lots of zeros. What's interesting in AI is there's three things that people don't think about. One, with the advent of that phone on your desk, the iPhone coming out in whatever, 2007, 2006, whenever, how many companies that didn't exist after 2007, that didn't exist before 2007, how many new companies were created that are worth over $100 billion?
Yeah.
3. ByteDance, Pinduoduo, and Uber. Only 3. You know who wins? Incumbents. So the incumbents are the giant incumbents like Salesforce or Microsoft or Oracle or Google or Snowflake. They're all going to win. 2, we've never seen growth rates like this in companies. I'm stealing a line from a very famous VC. They've never seen growth rates like this in companies, but they've never been shakier. In other words, the gross dollar retention rates aren't that good. So it's like a lot of people are trying this, but they're not sticking around to be customers. So it's like a lot of like project-based stuff right now. And I think that would imply that it's probably some sort of bubble.
Are we going to see those companies, though, the smaller ones? Are they going to fail? Are they going to be acquired? I guess in terms of consolidation, I think many people would say we'll see some sort of consolidation within the space. A lot of those startups aren't going to succeed. But are we going to see more of these larger players, the incumbents, acquire some of the smaller players? I guess, and when you talk about that timeline,
pennies on the dollar.
But when you talk about that timeline, what more realistically does that look like? Everyone's excited about it now. What's it going to take for you to get in?
When we see gross retention rates go up. So gross retention rates are all, what I mean by that for the viewers is before you have any upsells or anything, you take $100 a year of revenue. The next year you end up with $70 if you didn't add a new customer, or you end up with $95. Like 95 is best in class. Like think about people on Salesforce. It's like impossible to get off Salesforce or Oracle or like Microsoft Office, and these products hit very hard. But when you have like 70% gross retention rates, it just implies 30% of your customers are churning every year. And we're seeing really low retention rates. We will get interested in this stuff when gross dollar retention rates get 90 plus.
Okay, really quickly, like less than a minute here. You've said previously your biggest mistake in the last decade was not predicting multiple expansion.
Yeah.
Are you potentially making that mistake again by not getting in on AI right now?
Maybe, but that's fine. We don't have to. We can stick to boring software companies like Pacemate that make cardiac monitoring software, or Growth Zone that makes Chamber of Commerce software.
40% this year? Software is struggling right now.
That's the best time to invest in companies. But again, a huge amount of our portfolio will end up selling to private equity. So 60+% of our companies are profitable businesses where you've never heard of any of these businesses, like Growth Zone or GVL or Pacemate. They'll never be giant IPOs. We don't need them to. We'll sell them to one of 100 private equity firms, or we'll sell them to a tuck into a strategic and try to make 2 to 5 times our money, versus trying to bet on the IPO markets coming back. The reason the IPO market's not strong right now is if you run money at Wellington or T. Rowe or Fidelity, it's easier to go by Microsoft or Facebook or Google or Nvidia that are growing super fast. Because I think the biggest challenge in a lot of the software companies is, if you just look across the whole software ecosystem as public companies, they're not growing that fast anymore. A lot of them have slowed down a lot.
Well, Mitchell Green, we have to leave it there. But thanks so much for coming in studio. We look forward to hopefully having you back soon and continuing this conversation. Lead Edge Capital founding partner. Thanks so much, Mitchell.
Thanks for having me in.